speaking about to boost venture capital as well as boosting our investment in that particular regard. Lewis is a financial analyst. Tell us, why would I, as an individual, first of all, go into venture capital to invest there, and then there is bonds, there are stocks there, what is there to reap? And also kickstart it from what particular entities, organizations I highlighted for venturing into this capital investment or venture capital investment?
Why would I go into, if I'm a normal person in town or the street, why would I go, for instance, and back an early stage safe border instead of buying treasury bonds, bills, and stocks? And there's even an ETF in the market anyway. People at outlets have something called an exchange traded fund, where, but that's a story for another day. Again, venture capital is high risk, and like I've told you, anything that is associated with a lot of risk means that there are more returns if it succeeds. That is the idea. The reason why treasury bonds are not as profitable is that because they're fixed income securities. The risk is very low. Government is not going to run away. So if you invest in your treasury bonds, you're very sure you get your money. Yeah, the inflation may tamper with the coupon rate. It might. But still, you're going to get your 100 million if you have invested it as if you have got a treasury bond of a maturity of what, 2 years, or 191 days, or 182 days. You are sure that you get your money. Even when the government collapses, at some point you're sure the next government, because these are documented loans you're giving back government. So and it goes back to the point I was trying to say again. Anything that is high risk, anything that is that's associated with high growth potential comes with a high returns if it succeeds. That's one reason you would go into venture capital as a normal person at an early stage. And if an institution that can back an entity and a series round, Series A, Series B, Series C, because again those are the rounds that the priced rounds they call them, that where people go for venture capital to always keep getting money in subsequent rounds. You can, because if the margin, now for instance, you imagine someone who invested in Uber in 2012, 13. He invested, he put in very little money. The share at that point was less than $1, less than $100. Right now, just one share in Uber is about $33,000.
That has increased, of course. Events have rounded up.
So any early stage investor in a tech startup that can succeed, like Uber, like Facebook, like the global brands you see all over the place, Uber, Facebook.
You are highlighting more of technological applications, technological space here.
Because venture capital is preferred on this continent to back technology companies.
Okay.
And we're in a technology age. You're not going to run away from technology, because even the app, the phone you're using, all the applications you're using were venture capital backed. And Africa should look into the realm of how do we enhance technology growth. We're now in the fourth industrial revolution. People are speaking of cryptocurrency. People are thinking of Web3. So as a continent, how are you going to develop and compete with the rest of the globe in terms of technology? And one way technology can develop on the continent is by financing it. One mode of financing it, preferably, is venture capital. Like I said, no bank is going to let you get a loan to do a high risk business, because for them, they are into the business of making money from giving loans to business enterprises that can pay back, and those are short-term loans. Even when you're going to go to the stock market very early, if you don't have the financials, you can't go there. But as a tech startup, you can, if you grow to a certain stage and you can demonstrate, maybe you're even, like in Uganda, you're profitable.
You can go for the
you can go to the stock market and list, but the agenda for listing in the stock market should be exiting, early investors exiting.
Okay, and now talk to us about how can we effectively double down the financial investment for sustainable development.
Let's repeat the question.
How can we double down? How can we make sure we integrate financial investments for sustainable development, integrating all this? Because we're here speaking to people about now venture capital. There are stocks. We already highlighted on that. There is a lot in regards to digitalization as well, even in the tech space, that comes with financial literacy and all that. Financial investment, is wide. Like you know very well, Lewis. How can we double down on this to make sure we integrate it to sustainable living for the people?
Okay, again, if you're going to integrate investments, and maybe the question is quite vague, but I'll try to make out what I've tried to make out of it. If I'm to integrate investments, one, you need better regulations. The regulatory framework should be adequate. The business environment alone should be adequate. Now, for instance, in Uganda, venture capital investments are suffering from a bad regulatory environment, which is still young, archaic, and old-fashioned. Most startups that are raising money via venture capital, and I'll give you good examples, and you have seen them in the market. Cheaper Cash, Safe Border, and Civico, Wave. Most of them, what they do is once they start raising that money in rounds, once they are done raising the early stage money from family and friends and close relatives, and they're moving on to the rounds, the real rounds where they're backed by really global institutions. Like Alliance X, the German, I think, financial institution backed Safeboard on the latest round of raising venture capital in 2019, 2020, 2021, 2020, towards the end of 2020. What Safeboard did is they did what you call, oh God, I hope people understand this, a corporate inversion.
You can explain to us.
Safeboard came here as a company that was 100% Ugandan. Once they raised that money from an NGO, I'm forgetting what it was, what the name of the NGO.
Never mind.
$200,000. After that, during that process, the convertible note they got from an NGO, they were 100% Ugandan. When they moved on to, like I said, venture capital is raised in rounds, and at each round, the investor is exiting at a higher valuation. Once they started raising the monies of Series A, Series B, they went and incorporated a structure in Mauritius, which is called Safe Border Holdings, to own Guinness Transporters Limited, which was trading the Safe Border brand. But remember, when Safe Border came into Uganda, it was Guinness Transporters Limited. It raised its first convertible note, money that converts into shares at a future point. They're 100% Ugandan.
When exiting?
Now, how that NGO exited or got shares finally, when the new investor at a Series A round came, now the second round of raising the same venture capital, they had to incorporate an offshore company. Why? Because the tax liabilities that come with venture capital investments, if you incorporate 100% in Uganda, are high.
Okay.
So even the laws need to be harmonized. Government needs to look into how can we make the tax environment favorable, the regulatory environment favorable, generally that. And it's not only Safe Border, Cheaper Cash, what you have in Uganda is a subsidiary company of something that is in Delaware. Because most of the venture capital...
And which takes me to how Ugandans, as Ugandans, where you incorporate in government now, how can we make sure we improve these kind of investments, but from from venture capital?
For starters, and this is what I think government should do, one, you need to put in place seed enterprise investment schemes for venture capital funded businesses. In those, in those seed enterprise investment schemes, that's where you find the tax reliefs, that's where you find subsidies for the industries they're in. For instance, if you have incubators in place, government has put in place some incubators, but they're not enough. They need to be highly funded, because this is the next stage of evolution, technology. This is the human species. And technology is capital intensive. As government, when you put in place seed enterprise investment schemes, and the tax incentives are there, and the subsidies for the industry are there, and you have subsidized the data centers which these tech startups have to use, and you have even enhanced the education system in those hubs, innovation hubs, to teach and the business end of scaling a business, then there's no reason why more venture capital won't come into Uganda. Uganda last year raised around to 11 million to 15 million dollars, not shillings. This is dollar rate. You know, we raised about $15 million US dollars in venture capital. But it could be more, because the countries that are raising more money on the continent are, I think, Nigeria, Egypt, South Africa, and our next door neighbors, Kenya. What have they done differently? Kenya, they have, their tax regime is better. Much as, again, they do what they do in Uganda, they go and incorporate offshore company structures, but again, the market is mature for any tech startup, and it attracts anyone who's trying to fund the business. Capital Markets Authority has come up with regulations, and I feel they're wiseacring, because you're not going to regulate something that is risk capital. Already venture capital is funding risk capital. And now you're coming up with proposed regulations to register venture capital funds. And again, Capital Markets Authority is supposed to go back and analyze its role in the market. Capital Markets Authority, yes, regulates capital, but it regulates regulated persons that have subjected themselves to the law if you have got a license. You don't regulate asset classes per se.
Are you telling me it's doing something it's not supposed to do? At the end of the day, it's the regulators when it comes to finances, trusting people, because the public needs trustworthy entities that are coming to market to serve them.
Again, venture capital is high risk, and everyone who is into venture capital
understands. Less than 2 minutes here,
right.
Lewis. If we could wrap it up from there.
So, all right, venture capital, like I stated, is high risk. It's risk capital. But it's not the kind of investment that is given to the public. It's not a public offer. If you go into venture capital, you understand the associated risks of backing a business, and you know them, that the failure is high. Therefore, government and Capital Markets Authority is supposed to make sure they just regulate persons, not the transactions, not the capital adequacy ratios of venture capital fund. Uganda Revenue Authority did something good, but not enough, because again, Section 54 of the Income Tax Act that was introduced last year aims at giving reliefs to to venture capital businesses.
In just 30 seconds, Lewis,
okay.
You're summing up. I'm interrupting here. But drawing your point home, because after the break we're going to have sports coming up with Joram Sonko, something that you wouldn't leave out in 30 seconds as you sum up here.
The take home from this discussion should be that government should, one, put in place the enterprise investment schemes for tech startups. Two, Capital Markets Authority the regulations that they're proposing to pass, they should have more stakeholder involvement, because again, no country world over regulates venture capital the way you regulate a listed company. This is high risk money. And then finally, the tax incentives in the Section 54 of the Income Tax Act are not going to be leveraged by any venture capital fund that's investing into Ugandan startups, because it's inadequate.
Thank you so much. And that was Lewis KIZITO, is a financial analyst, highlighting for us what government should do and what we should entirely do to boost venture capital. After the break, Joram Sonko on your screen with Business and Sports. Stick around.